Today we're presenting on impact investing. My name is Susan.
I'm Diana.
I'm Jenny.
So what exactly is impact investing? Impact investing consists of investments made with the purpose of creating environmental and social change, whether that be to support sustainable agriculture or affordable housing in communities. Some businesses can create negative externalities such as greater pollution in the environment, so impact investing is a way for investors to combat this as they're investing in companies that are committed to corporate social responsibility. Some view this as an extension of philanthropy, and impact investing has proven to have positive outcomes as individuals have increasing awareness of these social and environmental issues. According to the GIIN 2020 Annual Impact Investor Survey, it has an estimated market size of $715 billion, which shows its growing potential.
So there are four major tenets of impact investing that need to be considered in order to establish expectations in regard to these investments. The first is intentionality. This characteristic highlights the investor's intention in investing money in a venture. This intention should not be solely to make a profit, but should also require that the investment will lead to a positive social or environmental impact. The second tenet is return expectations. The investor has set expectations that clearly outline whether the investor wants to make only its investment back or if they want to make a profit from the investment, and if so, what. Similar to return expectations, investors must decide what their expectations are for their investment. There are a variety of return options ranging from investors accepting below market returns to market beating returns. Each investor must clearly set its expectations before investing in a venture. This also includes deciding what asset class they'd like to be repaid in, whether it be cash, a fixed income, or equity. The last tenet of impact investing is impact measurement. Investors must commit to measuring the impact of the venture that they invest in to determine whether or not it is truly making a positive impact on society or the environment. This tenet is the hardest to accomplish, and we will discuss why later in the presentation.
There are two approaches to impact investing. The first approach is socially responsible investing. Socially responsible investing focuses on investing in companies that practice socially conscious behavior. For example, investors will filter out companies that are producing tobacco and weapons and focus on the companies that are creating positive social and environmental effects. A specific example of socially responsible investing is community investing. In community investing, organizations that have displayed socially conscious behavior are able to receive funds to create even more positive change within the community. The second approach is environmental, social, and governance investing. This type of investing focuses on determining financial success while investing in companies that make ethical decisions. Investors will evaluate companies based on their practices within and outside of the company and filter accordingly. For example, investors will be most likely to invest in a company that does not use child labor and will identify potential risks and opportunities. Investors believe that investing in companies that practice these moral behaviors is much less risky than investing in companies that do not. The main difference between socially responsible investing and environmental, social, and governance investing is that environmental, social, and governance investing looks to find value in the company in combination with financial analysis, while socially responsible investing takes the next step and filters companies based on a set of specific ethical guidelines.
So there's two types of investors that participate in impact investing. The first type of investor is called a financial first investor, and this type of investor focuses on optimizing financial returns while also achieving a social or environmental impact. These investors seek to invest in organizations that will be profitable and offer market rate returns. The positive social or environmental impact is only an added benefit for this type of investor. It's not the sole motivator. The second type of investor is called an impact first investor, and this type prioritizes social or environmental return on investment over financial returns. This does not mean that the investor does not expect to make its money back. However, the primary objective is the positive impact on the society or the environment, and the secondary objective is financial return. This type of investor is willing to take on a higher risk for not getting its full investment back, and is okay with that possibility as long as there is a positive social or environmental impact. According to the Global Impact Investing Network's 2020 survey, 67% of impact investors sought to get market rate returns, while only 15% were looking to make below market returns that were closer to capital preservation. So like I mentioned earlier, there's a wide variety of options that an investor can make when it comes to their return expectations.
Impact investing has shown to have positive returns as the market size is very large, but also matters to the public greatly. 64% of millennials, 54% of Gen Xers, and 42% of boomers said environmental, social, and governance issues influence their investing decisions. As individuals become more aware of these issues, this type of investing will most likely become even more popular.
So is impact investing successful? Whether or not it's a successful way to invest money and improve the environment or society is controversial. There are a lot of examples of successful impact investments. However, some people say that the measurement of success for impact investments is too broad and not consistent enough to truly know whether or not these investments are successful. According to the survey we mentioned earlier from the Global Impact Investing Network, almost 70% of investors say that their financial expectations for returns were met, and nearly 80% say that their expectations for environmental or social impact were met. This data clearly supports the idea that impact investing can successfully lead to both financial success and positive social and environmental impacts. Now we have some examples. So an example of a for-profit business that was positively benefited by impact investing is a restaurant called Everytable. CEO Sam Polk opened Everytable to provide healthy food to low-income communities located in food deserts where it's hard to find healthy food choices. Acumen, a nonprofit global venture fund, invested in Everytable, which has helped the business expand. There are currently 9 Everytable locations in California, each located in food deserts and priced according to what the community can afford. This business has been lauded as a successful impact investment since it's helping provide healthy food in poor communities, resulting in a positive social impact. However, there's no quantifiable information on the impact Everytable has had on the communities in California. A second success story is the organization Rent to Own Limited Zambia. This company provides farmers and agricultural workers in sub-Saharan Africa, specific Zambia, with the equipment they need to successfully run their farms. The company has added a benefit that the farmers are renting the tools with the end goal of owning them. Rent to Own was invested in by the London Foundation. The foundation provided Rent to Own with a royalty-based loan that includes interest. The foundation also receives a monthly royalty payment based on sales in return for its investment, and it owns a portion of equity in the business. This has allowed Rent to Own to increase the availability and accessibility of productive asset financing, which has led to the creation of jobs and wealth in Zambia. Again, the investment is considered successful in having a positive impact on society, but it does not provide quantifiable data that supports its claims of a positive impact. So like I mentioned earlier, while there's a lot of support around impact investing, there's also a lot of critique surrounding this form of investing. First, impact investing is a relatively new concept, which means there's not a lot of research surrounding the success or shortcomings of this type of investment. This means that there is a lack of substantial proof of successful investments. There is currently no track record of how many ventures that have received impact investments truly have had a positive impact on the environment. There are success stories, but that does not lead to enough data around the success rate of these types of investments. This leads to the next critique, which is that there is not a good system for measuring how impactful these investments are. Each business or venture that receives an impact investment measures its success and impact in its own way, which makes it hard to set a standard for success. Lastly, there is the fear that impact investing will replace philanthropic donations. Donations allow organizations and ventures to provide the product or service it provides without the promise of financial return. There is a fear that the amount of donations that are made simply to improve society or the environment with no strings attached will decrease as a result of impact investing.
Okay, so for the future projections of impact investing, there is growing interest among capital providers who seek diversification and a new approach to money management that enables them to also make a difference, as in potential investors are becoming more and more interested in putting their money towards major causes. So impact investing is a perfect opportunity for these individuals. So it's bound to grow alongside this interest. Impact investing assets under management are estimated to be increasing at around 18% per year among currently active impact investors, and it's projected to continue on this upward trajectory. And And major financial institutions have also already begun launching impact investing arms, and others are looking to get in on impact investing by actively investigating entry strategies. And research also shows that impact investing opportunities can generate returns to meet the expectations of investors across the risk return spectrum, which I'll talk about again in a couple of slides. But all of these point to the notion that the future of impact investing is looking bright and hopeful. So there are three main causes of growth within the impact investing industry, according to the Global Impact Investing Network. The first cause being that investors demonstrate a strong desire to align their investments with their values. So norms have been changing for a while regarding the roles of business in society. And so lots of investors want to hold businesses accountable for broader impacts on their stakeholders and the environments that they operate in. And then interest is also particularly high among the demographic groups that are set to control the most wealth in the upcoming years, which are women and millennials. And as millennials grow their wealth through earnings and inheritance, it's expected that impact investing will only continue to grow as part of the investing landscape. The second cause is that investors are displaying a growing understanding that considering the social and environmental impacts is good business. And this idea helps provide a greater license to operate, and it also helps improve profitability, especially in the long run. And then the last main cause that they identified is that investors manifest a desire to align with major global frameworks. So specifically regarding the Paris Agreement on climate change and the UN's Sustainable Development Goals, which have both explicitly called for private capital to finance solutions to social and environmental challenges, which is where impact investing can come in and play a role. Okay, so investors have been making impact investments for decades, but only recently has there been an emergence of a new collaborative effort to accelerate the development of a high-functioning market that supports this level of impact investing. And so while this market is still relatively new, investors are overall optimistic about its development, and they expect increased scale and efficiency in the future. And so these are some figures that look into where progress has been made within this impact investing industry, and also where challenges have come up for impact investing. So figure 10 in the top left shows that progress has been steadily made in things like skill sets and exit options, but also in the risk return spectrum that I mentioned earlier. But then figure 11 in the bottom right shows that there have been and will continue to be some struggles pertaining impact investing in things within the same categories that there was progress in, like exit options and appropriate capital within the same risk return spectrum. So going off of that, there are clearly some prospective challenges for impact investing going into the future. One of these being that as more companies try to partake in impact investing, there will need to be a higher degree of integrity and authenticity to make investors get involved and stay involved. Another challenge is that impact is somewhat vague and that it isn't consistently defined, regulated, or measured, which again can turn people away from partaking. And the biggest foreseeable issue goes back to the risk return spectrum that I've mentioned. And there's just a lot of concern over the lack of appropriate capital across the risk return spectrum. And it was actually perceived as the main challenge for the impact investment industry as of 2020 by organizations active in the industry. Okay, so this is just a quick illustration of the risk return spectrum with financial return on the y-axis and financial risk on the x-axis. But basically, ideally, you would want to be somewhere with low risk but high returns, but normally you're somewhere along the line, like moderate risk and moderate return being dead center. So the issue with impact investing that people have identified is that it's perceived as being unstable regarding returns, as there's like a big range of possible returns and investors look for different returns. And it's also potentially high risk with low return, which is the dot. So not on the line. And so getting over that hurdle to make people interested and feel secure enough is the biggest challenge for impact investing going into the future. But like I said earlier, and like figure 10 showed, research supports and shows that there have been major strides and progress made within the impact investing industry to improve this iffy risk return spectrum. And it's probably going to continue to get better, making impact investing a fairly successful venture to take on in the future. And then these are our references.